The sharp rise in silver prices represents a fundamental structural break in precious metals markets, rather than ordinary cyclical movement driven by temporary supply-demand imbalances or speculative enthusiasm. This structural transformation reflects the unraveling of price manipulation mechanisms that have suppressed silver values for decades, while physical supply constraints and accelerating demand create conditions that mathematical analysis suggests cannot be resolved through normal market adjustments. The convergence of weakening confidence in fiat monetary systems, mounting pressure on banking institutions, and systematic breakdown of paper market credibility has positioned silver to reclaim its historical role as a safe haven store of value. Understanding this structural break requires distinguishing between normal market volatility and systematic changes in underlying market mechanics that alter fundamental price discovery processes. Normal silver price movements reflect cyclical variations in industrial demand, seasonal jewelry consumption patterns, or temporary supply disruptions that markets can accommodate through inventory adjustments and substitution behaviors. Structural breaks involve permanent changes in market relationships, where traditional supply-demand equilibrium mechanisms fail to function effectively. Current silver market conditions exhibit characteristics consistent with structural transformation rather than cyclical adjustment. Physical silver premiums have expanded far beyond normal ranges while remaining persistent rather than temporary. Delivery delays have become systemic rather than isolated incidents. Industrial users report procurement difficulties that traditional supply chain management cannot resolve. Investment demand shows sustained increases rather than speculative surges followed by normal corrections. The physical supply situation reflects decades of systematic underinvestment in silver mining and processing capacity, combined with declining ore grades and increasing extraction difficulties. Unlike gold mining, where dedicated operations target gold specifically, silver production occurs primarily as byproduct of copper, zinc, lead, and gold mining, where silver represents secondary output. This production structure means silver supply cannot respond rapidly to price increases because mining companies focus on primary metals rather than secondary silver recovery. Dedicated silver mining operations face permitting delays, environmental compliance costs, and capital requirements that prevent rapid capacity expansion, even when prices justify increased production. New silver mines require years of development and hundreds of millions in investment before generating meaningful output. Existing operations confront declining ore quality that reduces silver content per ton processed, while increasing energy costs and environmental impacts that limit production growth. Processing and refining bottlenecks create additional supply constraints independent of mining production levels. Silver refining capacity operates near maximum utilization while facing energy cost pressures and regulatory restrictions that complicate expansion efforts. Transportation logistics experience delays when security requirements and insurance costs increase during volatile price periods. These processing limitations mean that even increased mining output cannot immediately translate into available silver supplies. The demand transformation reflects multiple converging factors that create permanent rather than temporary consumption increases. Industrial silver demand continues growing through renewable energy deployment, electronics manufacturing expansion, and medical device innovation that utilizes silver's unique properties. Unlike cyclical industrial demand that fluctuates with economic conditions, these applications represent structural shifts toward technologies that require silver components without acceptable alternatives. Solar panel manufacturing represents particularly significant demand because global renewable energy targets require massive photovoltaic installations that consume substantial silver quantities. Each solar panel contains approximately 20 grams of silver for electrical conductivity applications, where alternative materials reduce efficiency and long-term reliability. Current solar installation rates consume over 100 million ounces of silver annually, with projected increases as renewable energy adoption accelerates. Electric vehicle production creates additional structural demand as automotive electronics require increasing silver content for battery management systems, charging infrastructure, and autonomous driving technologies. Traditional gasoline vehicles use 15 to 25 grams of silver, while electric vehicles require 40 to 60 grams per vehicle. Global electric vehicle production targets suggest automotive silver consumption could double within the next decade. Medical device manufacturing utilizes silver's antimicrobial properties for surgical instruments, hospital equipment, and implantable devices where substitution risks patient safety and regulatory approval. These applications generate inelastic demand that continues regardless of price levels because healthcare standards cannot compromise on material performance for cost considerations. Medical silver demand shows consistent growth as global healthcare infrastructure expands. Defense industry applications create additional inelastic demand through electronic warfare systems, missile guidance technology, and communication equipment that requires silver's unique electrical and thermal properties. Military procurement operates independently from commercial market considerations while prioritizing performance reliability over cost optimization. National security applications generate demand that cannot be reduced through price rationing mechanisms. The monetary demand transformation reflects systematic loss of confidence in fiat currency systems that have operated through debt creation and central bank intervention for over 50 years. Global debt levels approaching $400 trillion while economic output remains below $100 trillion annually create mathematical impossibilities where debt service requirements exceed economic capacity to generate necessary payments. This structural problem forces continued monetary accommodation that undermines currency purchasing power. Central banks worldwide face impossible choices between allowing debt defaults that would collapse financial systems or continuing money printing that destroys currency credibility. The mathematical inevitability of this dilemma encourages systematic movement toward alternative monetary assets, including silver, that maintain value independently from government fiscal policies and central bank interventions. Unlike fiat currencies that depend on institutional credibility, silver provides monetary functions through physical scarcity and chemical stability. International monetary system changes add urgency to precious metals demand as multiple countries develop alternatives to dollar-dominated trade and reserve systems. China, Russia, India, and other nations have implemented bilateral arrangements that reduce dollar dependency while increasing gold and silver reserve accumulation. These developments suggest gradual evolution toward monetary systems, where precious metals play larger roles in international settlements and reserve management. The price manipulation unraveling reflects breakdown of mechanisms that have artificially suppressed silver prices through paper market intervention and coordinated short selling by major financial institutions. Securities filings reveal that several major banks maintain massive short positions in silver derivatives that were profitable when prices remained below $30 per ounce, but generate exponential losses as prices advance beyond $40, $50, or $60. COMEX futures markets show systematic stress as open interest representing claims on silver far exceeds available physical inventory, while delivery requests increase from participants seeking actual metal rather than cash settlement. The mathematical impossibility becomes apparent when examining warehouse statistics, showing registered silver inventories below 50 million ounces, while open interest claims exceed 800 million ounces. Even modest increases in delivery demand could exhaust available supplies. London Bullion Market Association operations face similar pressures, as traditional fractional reserve practices encounter increased demand for physical allocation rather than unallocated claims. The banking institutions that provide precious metal services through London markets may not possess sufficient physical inventory to satisfy allocation requests if investor preferences shift systematically toward physical possession rather than paper claims. High-frequency trading algorithms and systematic short-selling programs that previously provided artificial liquidity and price suppression may prove inadequate when fundamental supply-demand imbalances overwhelm technical trading strategies. Computer-driven selling programs cannot create physical silver when actual metal becomes unavailable regardless of price levels offered through electronic trading systems. Banking system pressure manifests through multiple channels, including derivative losses, credit quality deterioration, and liquidity constraints that affect precious metals market operations. Major commercial banks face substantial losses on short silver positions, while simultaneously confronting credit challenges from commercial real estate, corporate lending, and interest rate exposure. These compound pressures reduce banking system capacity to continue precious metals market manipulation. Regional banking stress creates additional complications, as smaller institutions face deposit outflows and lending restrictions that affect their ability to provide services to precious metals dealers and industrial users. Bank failures or consolidations could disrupt established relationships between financial institutions and precious metals market participants, while reducing overall system liquidity. Credit market tensions affect precious metals financing arrangements that enable normal trading and inventory management. When banks reduce lending or increase collateral requirements, it affects dealers' ability to maintain inventory levels, while potentially forcing liquidations that could accelerate price advances. Industrial users may face financing difficulties for inventory accumulation during supply shortage periods. Paper market credibility erosion occurs as investors recognize the disconnect between paper claims and physical availability while questioning the reliability of cash settlement provisions during genuine supply shortages. Exchange-traded funds face redemption pressures that could force physical purchases exactly when supplies become most constrained. Futures markets may implement emergency measures, including position limits or forced cash settlement that destroy confidence in paper instruments. Unallocated precious metals accounts at banks increasingly face scrutiny from holders questioning whether adequate physical backing exists to satisfy potential allocation requests. The fractional reserve nature of these arrangements works adequately when most account holders remain satisfied with paper claims, but becomes problematic when physical demand increases substantially. Derivatives markets show stress through increased volatility and wider bid-ask spreads as market makers face difficulty managing risks when underlying physical markets become disconnected from paper trading mechanisms. Options market behavior suggests increasing recognition of delivery squeeze potential, while futures curves show backwardation patterns typically associated with physical shortage conditions. The safe haven emergence reflects recognition that traditional safe haven assets, including government bonds and bank deposits, face systematic risks during monetary system stress periods. Government bonds carry negative real yields while facing potential default risks if debt service becomes mathematically impossible. Bank deposits encounter bail-in risks and institutional solvency questions. During banking system stress, silver provides safe haven characteristics through multiple mechanisms, including monetary properties that function independently from institutional credibility, industrial demand that supports fundamental value, and supply constraints that limit availability regardless of paper money creation. Unlike other safe haven assets that depend on institutional promises or government backing, silver maintains value through physical properties and market forces. Portfolio diversification benefits increase when traditional asset correlations break down during systematic stress periods. Stocks, bonds, and real estate all depend on the same underlying monetary and financial infrastructure that becomes questionable during currency and banking crises. Silver offers exposure to different value drivers that operate independently from traditional financial assets, while providing inflation protection and currency debasement insurance. International capital flows show increasing precious metals allocation as global investors seek alternatives to currency-based assets during monetary uncertainty. Sovereign wealth funds, pension systems, and insurance companies gradually increase precious metals allocations while reducing exposure to government bonds and bank deposits that face systematic risks during monetary transitions. Institutional behavior changes reflect recognition among professional investors that precious metals serve essential portfolio functions that become more important during periods of monetary and financial instability. Academic research on portfolio optimization increasingly recommends precious metals allocations, while institutional investment policies incorporate strategic precious metals positions rather than tactical trades. The store of value function operates through silver's ability to maintain purchasing power across different monetary regimes and economic conditions. Historical analysis demonstrates silver's performance during inflationary periods, currency devaluations, and banking crises, while showing resilience during various economic and political transitions. This store of value capability becomes particularly important when traditional alternatives face systematic risks. Wealth preservation considerations favor assets that maintain value independently from policy decisions and institutional performance, while providing liquid markets for portfolio adjustments. Silver markets offer global trading capabilities with continuous pricing while maintaining physical backing that eliminates counterparty risks associated with financial claims and institutional promises. The Industrial Foundation provides fundamental support for silver values that operates independently from monetary and investment demand, while creating baseline consumption that cannot be eliminated regardless of economic conditions. This dual demand profile distinguishes silver from purely monetary metals while creating unique market dynamics during shortage conditions. Technology sector dependence on silver creates additional demand stability because semiconductor manufacturing, renewable energy systems, and medical devices require silver components for functionality and safety. These applications represent permanent rather than temporary demand sources that continue regardless of economic cycles or investment sentiment changes. Energy transition. Acceleration toward renewable power systems guarantees continued silver demand growth through solar panel deployment, energy storage systems, and smart grid infrastructure that utilize silver's electrical and thermal properties. Government policies promoting renewable energy adoption create demand that operates independently from market pricing considerations because environmental goals override cost concerns. The mathematical inevitability underlying current conditions suggests continued pressure until fundamental supply-demand imbalances resolve through dramatic price adjustments or supply increases that require years of development. The structural nature of these imbalances means normal market mechanisms cannot provide quick resolution while forcing systematic changes in pricing relationships and market behavior. Timing considerations remain uncertain because structural breaks can develop over months or years while creating volatile intermediate conditions that test investor conviction and risk management capabilities. However, the mathematical constraints and physical realities underlying current conditions suggest eventual resolution toward much higher price equilibrium levels, regardless of specific timing uncertainties. Geopolitical factors add complexity through resource nationalism, trade restrictions, and international monetary cooperation that could affect both silver supply, availability, and demand patterns. Countries may implement strategic reserve policies or export limitations that compound global supply constraints while creating additional demand from nations seeking strategic autonomy. Environmental regulations increasingly affect mining operations through permitting restrictions, energy costs, and compliance requirements that limit production growth even when prices justify expansion. Climate change policies may further restrict mining activities, while simultaneously increasing demand through renewable energy technologies that require silver components. The feedback loop mechanisms create self-reinforcing cycles where supply constraints encourage demand acceleration while demand increases compound supply pressures. Industrial users may increase inventory levels when shortage concerns develop, while investors seek physical possession rather than paper claims when confidence in traditional financial instruments erodes. Market structure evolution toward physical preference reflects fundamental changes in investor psychology and risk assessment that could persist even after immediate shortage conditions resolve. The recognition of counterparty risks and manipulation potential in paper markets may encourage permanent shifts toward physical ownership that alter long-term demand patterns. Central bank responses remain uncertain because traditional monetary policy tools may prove ineffective when commodity shortages result from physical constraints rather than monetary factors. Interest rate changes cannot create additional silver supplies, while potentially worsening economic conditions through reduced investment in supply expansion projects. Emergency intervention possibilities include strategic reserve releases, import or tolerant export restrictions, or rationing systems that could affect market dynamics while potentially creating additional long-term supply constraints. However, government silver reserves remain limited compared to demand requirements, while intervention measures could reduce confidence in market mechanisms. This structural analysis examines observable market conditions and mathematical constraints, rather than providing investment advice or predicting specific outcomes. Silver market transformation involves complex interactions between physical, monetary, and financial factors that could evolve unpredictably, while creating both opportunities and risks, requiring careful evaluation. Understanding structural break characteristics provides context for recognizing that current conditions may represent permanent change rather than temporary disruption, while requiring adaptive approaches to evolving market realities.